What would you do if one day 50% of your life savings had been wiped out? What if you attempted to withdraw funds from your bank, but you're limited to $200 a day? What if your entire investment portfolio suddenly lost 50% of its value? This may seem like a scenario from a distant future, but unfortunately, we may witness this scenario sooner than you think. While the U.S. government continues to sink deeper and deeper into debt with no real plan for repayment, it is still able to borrow money at incredibly low interest rates. The same cannot be said for small businesses in the U.S. that are struggling to get access to capital. To illustrate this, imagine two very different yet extremely common scenarios where two entities both walk into a bank to apply for a loan. This is John. John manages a business with a workforce of 20 employees and requests a loan of $150,000 to acquire a distressed company in the same industry at a discounted rate. Now, let's meet Mr. Smith. Mr. Smith is the official representative of the government and is requesting a $1.5 billion loan to meet the country's ongoing maintenance requirements. John has been a loyal client of the bank for over 20 years and has no debt at all, and has never had any issue making his payments on time or even approached the credit limit. Mr. Smith's debt has increased over the years and especially in the last decade. Mr. Smith explains that the state's expenses exceeded its revenues, which led to a further increase in the debt by $1.38 trillion. John has a fair credit. In the past, he missed a couple of payments 2 years ago, but paid off his debt in full, and his company even reported a small profit in the last 2 years. John has a solid plan for growth. Mr. Smith claims he has always paid off his debt, but the cash flow is not so good. To cover the deficits, the government continued to borrow, resulting in a debt per citizen of over $88,000 in 2021. Its debt to GDP ratio is now among the highest in the world. Despite this, credit rating agencies still assign the government a premium score for the possibility that it will be able to repay the debt. Now, let's see which of them has been approved. John got the following answer from the banker. We went through all the forms and decided to deny your request. Your credit score is too risky. We're much more strict when it comes to credit now, and we don't believe you'll be able to repay the loan in full. For Mr. Smith from the Treasury Department, the approval is crystal clear. According to the credit agency rating, you're almost perfect. We went through the presentation, and according to the conduct today, we found no chance that the debt would be returned. However, based strictly on the level of the premium you received from the credit companies, we decided to approve the loan. Of course, this is an entirely imaginary example, but while the operating scenarios are still far and we really hope we don't witness it, the risk increases gradually. What do you think? Would you be willing to provide a personal guarantee to a business that is consistently experiencing a financial deficit? Is it reasonable to assign a top rating to a company that is experiencing a growing deficit? Can the U.S. national debt realistically be repaid in the future? The following videos will talk about how the U.S. can deal with the growing debt and how you will be able to defend yourself if a debt crisis comes. Thank you for watching. We would love to know your thoughts, so feel free to share them with us in the comments below.